de oportunidades de inversión y de impacto de esa guerra arancelaria con Kevin Thozet, miembro del Comité de Inversión de Carmignac. Good afternoon and welcome.
Good afternoon.
How has the ongoing trade war impact foreign direct investment in Europe, particularly in manufacturing and technology sectors?
Well, I mean, clearly Europe is a let's say global heavyweight in both inward and outward foreign direct investments. So it's in the end, I think it's part of the negotiation in fine with the US. So that's we're more looking at kind of outward foreign direct investments. The question is whether we'll have kind of less tariffs in Europe, and that would be more automotive plants in America, let's say. So our view is that it's part of the measure approach, but in fact, for now, the EU Trade Commissioner is not saying he's getting any clarity or any clear signal from US authorities. So that's the entire question for outward foreign direct investments. It's whether we'll only be buying liquefied natural gas or if it will come with foreign direct investments and manufacturing facilities. If we now look at inward foreign direct investments, which is also very important, well, in fact, Chinese has been deploying investments in Europe already. Yeah? We have had plants in Hungary, for instance. We have had investments in Spain as well, in the renewable space, or in the auto sector as well, with Chery Auto, for instance. So that's how I'd frame it. But beyond those foreign direct investments, it's important for investors to keep in mind that, in fact, capital outflows continue to flow out of the US to the benefit of the euro, the Japanese yen, or the Swiss francs.
Kevin, in what ways could tomorrow's inflation data influence the European Central Bank's monetary policy, and how might that affect investor sentiment across EU markets?
Yes, well, tomorrow is the second version, so the confirmation of the inflation print, and the first one was rather positive. We have had base effects on inflation, which has been favorable. If you dial back a year ago, Easter was on the last day of March last year. And typically Easter is the moment where we're seeing service packages marking up prices for the season. So in fact, what we expect and what should be confirmed tomorrow is that service inflation should be moving from 3.7% to 3.4%. And so what does this mean for Thursday, where I think market participants and the ECB will be confronted on the fact that they will lower policy rates from the 2.5% to 2.2% on Thursday. And clearly the Trump policies are inflationist for the US, but they're rather deflationist for the rest of the world. And the lower oil prices, the measured tariff responses by European authorities, and the higher euro all mean what? That in fact we have limited inflation concerns for now, and if anything, there's a risk of undershooting target by the European Central Bank. So policy rates should be going much further from where they are today, for around 1% lower, I would say.
Finish, Kevin, given the increased volatility in global markets, what strategies are investors using the hedge against uncertainty while still seeking returns in European equities or bonds?
Well, I mean, in bonds, the question is that we have this stagflationary nature of tariffs and the looming recessionary pressure. In such an environment, I would tend to say that, in fact, inflation-linked bonds is the instrument to tackle such stagflationary concerns. Why? Because either growth falls and flutters, and in fact, real yields have entered into positive territories since the beginning of the year, and so they give some way, they give back, or inflation expectations for the region are moving higher because of the fiscal response and because of the stagflationary nature of tariffs. On credit markets, or on, let's say, risk assets in general, we continue to be buying protection, so buying protections on credit markets. So we're buying credit default swaps, it's a bit like an insurance, let's say. The level of protection, given where spreads are today, around 370 basis points, is lower than when they were a month ago, when spreads were at 300 basis points, let's say. So we're hedging around 50%, half of our credit book or credit investments. Then comes equities. And in fact, as you were saying, with the high level of uncertainty, the high level in fear, in fact, has been fueling the VIX higher, so the volatility index higher for April month, but also for June. And in fact, we have the volatility of the volatility, which is very high as well. So also reflecting this uncertain environment for volatility itself. So in such a context, buying options to hedge an equity portfolio is rather expensive, so we prefer to use future markets to do so. And finally, I think there's another very important element to it, that's the currency. And in fact, the euro and the European bonds have shown that they can provide some form of stability, even though we had a massive sell-off in US markets, and the euro currency has been acting as a safe haven, let's say. Same applies for the Japanese yen. And to finish, I think active management is also a very good way to be protecting yourselves in such an environment. And the first part of the year, we saw what? We saw equity prices falling. We saw fixed income indices falling as well together. And in this period, flexible bond funds, cross-asset funds have delivered positive returns. So in fact, active management can be very useful, and notably when it's most needed.
Entonces, miembro del Comité de Inversión en Carmignac, thank you for joining us.
Muchas gracias.
Y vamos a continuar, lo vamos a hacer mirando a ver cómo han despedido